Welcome back to the marketplace. Now, according to Sanlam's report on the investment forecast, in the next coming years, offshore equities are set to decrease from 58.3% to 21.7% in 3 years and to 16% in 10 years. Essentially, what this means is that for the Nairobi Securities Exchange, more than a half of the shares are usually traded by, foreigners. What does that mean, this steady decline? What does it mean, Nganga, for us?
What it would indicate in such a case is that there is a growing retail and local institutional market that's actually increasing and taking up significantly more stakes and volumes in the stock market. Mm-hmm. So that decline, which, by the way, I'd be very interested in seeing what the data says about that. The decline would typically be driven, or is typically driven a lot of times, by the changes in investments in foreign markets. So, for instance, the U.S. increasing its rates over the last, I think, year or so, pulled out a lot of money for better returns in dollars back in the U.S.
Right.
So that has led to a slight decline in the number of investors that are out in the foreign markets. One of the biggest challenges we always have is the conversion and purchasing power parity. So you'll find that the amount of money that is available to foreign and more advanced markets will typically be significantly larger than what's available in our local in our markets. So the growth, and to minimize that, would require that there is a lot more participation from local investors, and these local investors essentially being both institutions and retail investors. And so seeing growth in that then is likely to drive the reduction percentage-wise of the foreign investors. Yeah.
And Eric, of course, participation of local investors is essentially a good thing for the country in general. However, how about, FDIs, foreign direct investments? How about the drive for foreign exchange? How is this going to affect the coming in of foreign exchange to the country?
Yeah, obviously we need both foreign direct investors. The more the merrier. In the stock market, you need all the money and trying to do all this discovery.
Right.
Because if you need to raise capital, you need both local capital as well as foreign capital, and they all meet in the market to be able to drive excitement. So obviously the reduction in foreign investor participation is not good, and we hope that's going to recover. Part of the reason is what Mashari has mentioned, but I think there are also uncertainties around our currency, the challenges around the pricing and the availability of currency. And if you can't sell and get your dollars out,
right,
or you can't, and as our market, we have freedom of movement of currency. That's a big challenge. It doesn't matter what the exchange rate is, as long as you're able to buy and exit into the market. That was certainly a big challenge in the course of last year, and hopefully it's improving. But with the currency having weakened to where it is, we even started seeing some foreign investors start to come in. I think in the first week or second week of this year, we started seeing some interest. And hopefully that's going to build up depending on how the global markets perform in terms of interest rates for the rest of the year. Yeah.
And of course, Nganga, when it comes to, attracting more foreign investors, our economy is steadily growing. I think we're going to be the fastest growing economy. When it comes to FDIs, I think we rank third now in the world globally. And when it comes to our interest, not even interest rates, when it comes to what is it called?
Startup capital?
Not even startup capital. It's around 6.6% inflation.
Yes.
When it comes to our inflation, we're at 6.6%. Last year, we were at almost 10%. Of course, when foreigners are coming in to give their investments, they're going to be, looking at these numbers. They make sense, but the Kenyan shilling right now is at 163. These are two very contrasting, when it comes to entities, two very contrasting things. When it comes to ensuring that you, as a trader, are attracting, the foreign investors who are coming in, what do you tell them?
For us, we work a lot, particularly with Kenyans in the diaspora,
right,
because we've got a platform that allows them to actually buy and sell securities by themselves. So one of the things that we actually drive for them, in this case, would be what $100 would have bought you a year ago now has increased by almost 60%. So you can actually make significantly larger investments, and prices have dropped. So you're able to make significantly larger investments for less cash than you would, or for the same cash that you would have had, and you have an opportunity for actually holding off and waiting for a longer period of time. And especially as the shilling declines, of course, if you are invested in the market, getting out creates a bit of a problem. But if you're outside the market, coming in now, gives you much larger capital based on the current pricing that we are seeing. The other thing to kind of observe is that the shilling weakening against the dollar wasn't just about the shilling itself, but also about the dollar strengthening against major currencies across the world, with a lot of the actions that the Federal Reserve has been taking over the last couple of years. So we expect to see increasing investment, at least, if we can take care of the availability of FX, so that if somebody actually wants to be able to buy dollars or exit their dollars, they can actually receive it, just like Eric said. That's the primary thing that we would worry about. But what we tend to see with a lot of the investors that we have on our platform, they're investing to come back home. So for them, the fact that they can get more now that the shilling is weaker actually is quite appealing for them, because they're able to put in more cash, less dollars or the same amount of dollars that they were putting in previously, but they're getting significantly more shillings. So they're able to build their wealth in local currency with the intention of coming back home to settle down and retire, and having made these investments when they were cheaper relative to what they might have been if the shilling hadn't weakened. So there have been some opportunities of that nature that we've seen. I think you've seen even with diaspora remittances have skyrocketed. We're doing about 671 billion in the last year or so. So there have been some benefits, let's say, for the individuals who essentially would like to remain domiciled in shillings and will make the investments from dollars into shillings. So we've seen some good opportunities for some of our investors. Yeah.
Essentially the silver lining.
It's become cheaper to invest in the country.
Yeah, and I hope that actually drives up, some of the foreign exchange that's coming into the country. Eric, when it comes to the Capital Markets Authority, one of their mandates is protecting and growing the capital markets in the country. It should be marketing Kenya. Do you believe that it is marketing Kenya as a trading destination? How do we look when it comes to the international scope, even within the continent?
I think for the Capital Markets Authorities to be able to provide that enabling environment from a regulatory perspective. Of course, there's that secondary aspect of being able to market Kenya, but it's really ensuring that there's integrity in the market, and that provides confidence to investors when they're looking to invest into our market. I think to that extent they've improved. They've done well, I would say. There's various regulations. I think we need product. Maybe they moved ahead in terms of just having the regulation, but we need products which are also relevant. How do we ensure that the stock market remains and speaks to the ordinary public? So there's things to just look at that. But in terms of enabling environment, they've been very receptive. The transactions, as few as and far between that have come, they've been very responsive in providing feedback. They've been able to run companies through the regulatory sandbox and be able to accept new ideas. So I would say the CMA has, in a way, really sought to develop the market. I think it's to really strengthen also market players and the overall economic environment, which is also really critical for the performance of the economy. And our market, even though it's performed poorly, we are still doing well. I mean, Kenyan companies, even when we see foreign direct investment having fallen, in the previous years we've seen Kenyan companies investing across East Africa. We've seen major investments by Safaricom into Ethiopia. So of course, if you're looking at money that is coming in and you net it off with what Kenyan companies have invested across the region, you can see that's a challenge. And obviously, it's something we need to work on, not to discourage Kenyan companies from expanding, but also being able to just attract capital into the country and in large buckets. And I think government is trying to do that through the special economic zones. I think they're trying to work around the regulations, reducing the cost of power. But all these things take time. And, ultimately also citizens want to see results.
Right.
but I would say it's really for everyone to just keep what they're doing and try and focus a little bit more on the needs of the country. Yeah.
Eric, you've said something very interesting. You've said maybe diversifying the trading instruments would help in ensuring that these numbers are, boosted, essentially. Nganga, when it comes to the Nairobi Securities Exchange, other derivatives, are we using, essentially when we're competing with other markets, are we using the derivatives that they're using as well?
So we do have some derivatives available in the market. We've got some single stock options. We've got a few of these that are tradable on the next. There's the gold ETF as well that are actually tradable on the next market. We haven't seen the kind of uptick that we would have liked to. I can tell you for one, given that we are a technology business, we were quite excited with the introduction of day trading and the introduction of derivatives that would allow now our users to consistently and continuously be trading. But I think there's a massive gap in terms of how kind of they're marketed and who they're marketed to and how they're actually designed and structured. I think one of the key things that we've really struggled with, for instance, for ourselves and kind of the research that we do in what our clients are looking for and what our customers are looking for is that there seems to be a massive disconnect between what might actually be available and acceptable for people's investment goals, particularly on a personal basis, versus what's actually available in the market in terms of, kind of investing for yourself.
Right.
So with the derivatives, we should see significantly more growth and introduction of a lot more of these derivative instruments to try and actually now break apart like the liquidity issue so that you can have more liquidity available via derivatives without necessarily having to have the trades happen on the stocks themselves that we'll find in some cases don't necessarily trade as much as they could.
Right.
Given that a lot of times they'll be held by institutional investors in large chunks for long periods of time. Yep.
Now, gentlemen, I'm about to be very controversial. Well, not necessarily controversial, but when it comes to floating bonds, a lot of people would not prefer it when it comes to trading. Why do you think, first of all, I'm sure a lot of viewers are confused, what exactly are floating bonds and why is it not necessarily a preferred form of trading?
And when you're looking at this perspective, is most of the bulk of the bonds which are issued by government.
Right.
I would imagine if you're a government, you want a bit of certainty about the kind of rate you're going to pay in the future. So obviously, if it's floating or maybe inflation linked, the actual obligation that you end up paying starts fluctuating, and that can also potentially create problems of its own. It's worth exploring, but that can also have other implications. We know, for example, locally, we know companies which took debt and they were pricing off, for example, LIBOR, now it's SOFR, and of course this benchmark rate adjusts over time. Which now means if this benchmark rate adjusts, on this other side, you end up paying a higher interest rate. And so obviously it's up to the central bank to look and decide whether this is the best possible way of doing issuances. They're usually also very clever in the way they issue their debt instruments. They don't want to lock themselves for a long time with very, very expensive debt. So when interest rates rise, what they do, they start issuing short-term instruments so that, if interest rates turn, that's when they start issuing like 20 years or 25-year instruments. So the central bank also has a treasury mandate in trying to minimize the overall cost to the economy. I'm sure they would have considered that, and maybe they would. If it makes sense, I'm sure they would consider it.
Nganga, Erica said something very ominous. He said there are consequences. What are your views on this topic?
On the topic of floating bonds?
Yes.
I hold the same position as he does. You'll find that one of the biggest problems that you might have with something that's not fixed is, one, it makes even your cash flow planning a little bit more difficult. If it's inflation linked, if inflation is going up, then it means the incremental costs that are being paid out actually higher. But on the investor side, if you're invested in something that's actually inflation linked, it actually helps because it means that this rate will increase your returns based on how well the economy is doing or how badly it's doing, how the inflation rates are going up. or whatever benchmark has actually been utilized. So it gets more expensive for the government from the public finance management side of things. On the investor side of things, then that kind of an increase actually creates higher returns for you. The downside of it is, on the flip side, is that if it's getting cheaper for the government, if the rates are going back down, it also means that the returns that for you as an investor might have been receiving will also be declining in the same direction. So it is a very interesting, let me say, it's a very interesting instrument in its issuance. It needs a lot of kind of figuring out. So if you expect that the interest rates are going to keep going down, so as an issue, it does make sense. If you're linking it to inflation and you can see that you're actually taking certain actions towards reducing inflation, it does make sense to issue something that will get progressively cheaper. But as you mentioned, then what happens is that if it's going up, the government will choose then not to take very long-term paper and just decide that we're going to lock in this 18% for the next 364 days or for a maximum of up to 5 years, let's say, in this case. And then as it gets cheaper now, they'll be able to issue longer term paper. So the same thing, I think, would be what might actually be influencing them when it comes to the issuance of these floating rate bonds. Are we likely to see the rates actually decrease and so it gets cheaper over time for the issuer? Or are we likely to see the rates increase, which then I guess is usually a lot of what you might call looking into the magic box and trying to see which direction will the country go. Will there be another pandemic, or so trying to do these predictions and making these choices. But as he said, the guys who actually are responsible, the teams that are responsible for putting these things together, will typically have done a lot of this research before they make their decisions to do so.
Right. With all these fluctuations, as you said, you're looking into a magic box. You're supposed to predict a lot of things, gentlemen. I'm sure a lot of businesses are right now thinking they're not really thinking of listing. And that's a major problem for the Nairobi Securities Exchange and the involvement of locals in this particular, aspect. When it comes to listing of normal businesses, Eric, what would you say are one of, or rather the main factors that holds them back from listing?
Obviously, there's elements around the corporate governance that comes with listing. There's usually long procedures. You, as a founder of a businesses, most businesses in Kenya are family businesses. They have to let go of the ownership because now once you bring in other shareholders, the other shareholders want transparency. They want the entire pie. If it's being split, it's split from, in a transparent way. And obviously that's a challenge. But I think also historically as market players, we probably focused on bigger companies. How do we service smaller companies? Could there be other players who come in and service smaller players? I think the regulatory space has also improved to try and be able to accommodate smaller advisors. But that license has not been taken up as much. Then there's just the overall performance of businesses. I mean, we know in the stock market about a quarter of the companies issued profit warnings last year.
Yes.
It's probably not so different in any other companies that would have operated in that environment. And so that's also something we need to be aware, because if you bring companies to the market, they need to be good quality companies. While it's still the decision of an investor to kind of make a decision whether to buy or sell, we need good quality companies. We need them to be doing manufacturing, we need the IT, those sectors that we think are doing well or are likely to do or to drive our economy forward. Those are the ones we should be focusing on. Pharmaceutical sector, so less on trading companies, but more on maybe export-oriented companies or companies which are doing import substitution, mining. I think I saw a mining company looking to list. I mean, those sorts of companies, I think those will be the ones which, if they come in and they're delivering good numbers, those will be good for our economy. But I think it's a joint effort, and I don't know, it's something that we need to keep working on it.
Right. I think this change of perspective, Eric, is going to be really good, especially the involvement of the manufacturing sector, considering that it is one of the major pillars of, the current government and on growing the economy in the most, natural way, progressing the economy in the most natural way. Nganga, when it comes to, we've spoken about, the Kenyan culture. A lot of businesses do not want to be open with their earnings every single year. They don't want to be held responsible for that. But going into the stock markets is probably one of the easiest ways to mobilize funds. What do you think we should do? First of all, is it a culture problem? Because that could be my opinion. And second of all, is this a perspective we can change for the greater good of the entire, country?
So you're very right. One of the biggest challenges about getting listed, from even the discussions the exchange itself has had with a lot of businesses, is people do not want to get visible. They do not want to have their numbers and everything about their businesses just being put out there. And you have to publish it in the newspaper so everybody can actually see. You've got your dirty laundry out there. So
Right.
if you're doing well, you're happy to put it out there. If you're not, you kind of want to hide that away from people.
Right.
So there's always that fear that if we become visible, we have to behave ourselves all the time, and the CEO doesn't want to let go of his, the things that he's become accustomed to that now would be required, that he lets go of, the owner of the business lets go of these particular aspects of the business so that they can, because it's now a public company, it's a company that's owned by the public. But one of the biggest challenges from my perspective is the pricing at which, or the level at which that the Nairobi Securities Exchange has always invited companies to become members has always been way later, at a point where you've actually figured out how to raise money at the beginning. You've built the business to a point where it's got X amount of capital, X amount of profit, and so that became the view of the exchange. People saw it as the place where when you get big, you now go to get bigger. Right. While in essence, capital markets are supposed to be about risk distribution. So small businesses should be able to access, I should look at this business and decide, I like the color of the font and I want to invest in it. Whether it's the fundamentals are different, whether or not what it does is that it distributes the risk. So if I need to raise, let's say, just 10 million shillings in order to set up my business, it should be possible for me to distribute this risk to a point where the investors who are coming into it are not taking massive stakes. It's been distributed across so many people that the loss, or not, if the business doesn't work out, the loss at a per individual level is quite low, right? But the opportunity for gains is also quite high. So I think there are still, like he said, other players, other smaller steps that need to be laid out. So that this risk distribution actually happens when there's risk, which is usually at the beginning of the business, so that as it graduates and gets bigger and gets more solid. I mean, by the time Safaricom was listing, it didn't really need any of the external money. Like, it was a big business; it was generating billions in profits and whatnot. But for the small manufacturing plant, the person who wants to set up, a space that's just one warehouse, wants to put in like 4 or 5 machines and needs to raise this money. There isn't that many options of being able to crowdfund it, to get other people to come in and take a stake in it. Partly one, again, of course, like he said, corporate governance. So a lot of times you don't want to have somebody who says, I'm starting a company, I'm going to do this, and then once they've raised money, they just go buy themselves a car and disappear. So avoiding those kinds of situations is typically why there will be these certain requirements for certain levels of the business to have reached a certain, kind of corporate governance maturity, revenue levels, profitability levels, or approaching profitability, or certain growth and so forth. But it still creates, again, the question of who's helping get these businesses started, who's helping this manufacturer expand to their second branch, right, to their third branch. And what we've begun to see is that the capital market space and the Nairobi Securities Exchange is losing out significantly to the private equity space. So businesses that would typically have ended up as listed companies have just been bought out by private equity players, who in turn sell them to private equity players, with, again, and so forth, with the idea at some point that they might actually list the company. But if it never gets to that point, they just keep selling them on to different players, awaiting the market to kind of show signs that it could receive a good listing. Because you see, even the investors on the inside don't just want to list, they also want to list and be able to make money out of that listing by selling off their shares to more people, so that they can actually also get some gains out of it.
Right.
Yeah.
Right. And Eric, when it comes to, of course, sometimes catering to the smallest fish might not be for the greater good of the pond. For these small businesses, of course, you've said that one of the solutions is that there are, market players who are coming in to specifically cater to this particular demographic. But when it comes to the privatization bill, and now that we're also concluding, do you believe that with, government agencies, half government agencies coming into this particular market, that it's going to push the small fish further out of the pond?
I think actually being able to deal with the small fish will be important for the entire pond, because if you're able to grow the small fish and nurture them to grow, that's going to be the pipeline of bigger companies in future. We've seen accelerators, for example, provide some sort of seed capital. But of course, as is mentioned, at some point they get taken up on the private equity space. We know government agencies, Kenya industrial estates, on the manufacturing side, they're very good at providing debt, I think from 1 million to 10 million range. But I don't know, maybe that's why stock market players should be hunting for companies to provide funds.
Right.
Kenya Development Corporation. There were some entities which were structured in the past and they had that initial focus, but I think at some point along the way we lost track. And obviously it's to try and see how we can regrow the path. Manufacturing as a percentage of GDP has actually been declining, and unless it starts growing now. But actually it's been declining for I think almost a decade now. So obviously it's something that really needs to be restarted. And looking at the new industries, services has been a major growth factor for the economy. How do you tap into these sectors of the economy? And for me, that becomes really critical for the overall growth of the market.
Right, and your final sentiments?
Yeah, my sense is that it's darkest before dawn.
Right.
I think I would say, despite all the challenges our economy is facing on the economic front and the macro space, I still think that the fundamentals being built for the long term, I think are going to be good for the economy.
We've all turned into, motivational speakers. It's darkest before dawn. The only way from when you're at rock bottom is up. What are your final sentiments?
I guess that's pretty much the same, because there isn't much else you can do besides kind of grin and bear it and say that these things are actually going to get to improve. Right. But he's made a very good point that one person's problem is usually another person's opportunity. So the government's problem of high credit and the impact of it is an investor's opportunity. So the key thing I think for me would be anybody who's watching this is to number one, get really educated, but also secondly, actually begin to pay attention to the opportunities as they come and go. Some of them are, creating problems for others, but then they're creating new opportunities. So there are still very good opportunities in the market. There's still very good returns to be had. There's still great opportunities for growth. We're expecting to see things begin to ease up, GDP predictions. So again, we just keep saying the same thing everybody's saying and say, you know what, things are likely to improve and possibly over the course of this year, and just keep monitoring and seeing what we can do.
Right, there is hope, and those are the sentiments from the markets, for the markets, from market players. This has been The Marketplace. We're throwing the word market around so much tonight. Of course, as they say, it's always darkest before dawn. For people who are looking to join the stock markets, maybe this is your cue to start venturing into it. Find tidbits that are going to be helping you in your venture for small businesses. This could be the easiest way for you to seek